What if I told you the single largest silver price crash in modern history wasn't an accident? It was engineered. March 2008. Silver plummeted 27% in 3 weeks. Investors lost billions. The official story? Market correction? Natural volatility. The invisible hand doing its thing. But here's what they don't tell you. The crash wasn't caused by supply and demand. It was caused by something far more sinister. A coordinated attack using financial derivatives, specifically commodity futures, manipulation and margin requirement changes orchestrated by exchanges controlled by the very banks who profited from the collapse. Now, before you click away thinking this is ancient history, ask yourself this. Why is your purchasing power evaporating right now? Why does everything cost more while your salary stays flat? Why do you feel like you're working harder but falling further behind? The answer is buried in what happened to silver in 2008 and what's still happening today. See, silver isn't just a shiny metal. It's the people's money. It's what ordinary folks could actually afford when gold became too expensive. It's industrial, monetary, and accessible, and that made it dangerous to a system built on paper promises and infinite debt. So they killed it. Not physically, but financially. They turned silver into a controlled asset, a casino chip in a rigged game where the house always wins. And here's the kicker. The exact same mechanism that crashed silver is now embedded in every major commodity market, stock index, and currency pair you can trade. It's faster now, more algorithmic, more hidden. The 2008 silver crash wasn't the end of anything, it was the beta test. Where are you watching from right now? Drop your city or country in the comments because this story spans continents and connects dots most people never see. If you're tired of sanitized financial news that protects the guilty, hit that subscribe button. This channel exists to expose the unfiltered truth about how markets really work and who profits when they break. Today, we're going deep into the derivatives casino that destroyed silver's monetary status, bankrupted retail investors, and set the template for every financial crisis that followed. By the end of this video, you'll understand why silver's 2008 collapse was never about silver at all. It was about control, about maintaining the illusion that paper currency backed by nothing can function forever. And you'll understand why the next crash, the one brewing right now, will make 2008 look like a warm-up. Let's start with what really happened when silver hit the floor. To understand the 2008 silver crash, we need to rewind to late 2007. Silver was on fire. From January 2007 to March 2008, it had climbed from $12 per ounce to nearly $21, a 75% gain. Why? Because smart investors saw what was coming. The housing market was imploding. Bear Stearns had collapsed. Credit default swaps were ticking time bombs. People were fleeing into tangible assets. Silver became the refuge of choice for middle-class investors who couldn't afford gold's $1,000 per ounce price tag. Industrial demand was strong. Electronics, solar panels, medical equipment. Investment demand was surging. Exchange-traded funds were launching. Mints couldn't keep up with coin orders. Every signal pointed up. Then, March 17, 2008 happened. Silver dropped $3.35 in a single day, a 16% crash. Within 3 weeks, it had fallen from $20.92 to $15.23. Retail investors who had bought on margin got liquidated. Long-term holders panicked and sold. The rally was over. The official explanation? Risk-off selling, deleveraging, flight to cash, generic market forces. But here's what the mainstream narrative conveniently ignores. The crash coincided with 3 specific events that had nothing to do with silvery's fundamentals and everything to do with institutional manipulation. First, on March 14, 2008, the COMEX, the New York Commodity Exchange where silver futures trade, raised margin requirements by 15%. This meant traders needed more cash up front to hold positions. Sound familiar? It's the same tactic crypto exchanges use today to force liquidations during volatility. When margin requirements spike, small traders get forced out, while big banks with infinite liquidity scoop up contracts at discount prices. Second, Bear Stearns collapsed on March 16, 2008. But here's the detail they bury. Bear Stearns was a massive player in commodity derivatives. When JPMorgan Chase absorbed Bear Stearns in a government-orchestrated fire sale, JPMorgan inherited Bear's enormous short position in silver futures. Suddenly, the bank that would later pay $920 million in fines for precious metals, manipulation controlled an even larger concentrated short position. They had every incentive to crash the price to cover profitably. Third, the Federal Reserve opened unlimited currency swap lines with foreign central banks on March 11th to 8. This flooded the system with dollar liquidity, temporarily strengthening the dollar and crushing dollar-denominated commodities like silver. It was coordinated monetary policy designed to save banks, and silver was collateral damage. Now let's connect those dots to today. Sound familiar? The margin requirement manipulation? It happened again in 2020 when silver briefly spiked during the Wall Street bets squeeze. Comics raised margins. Retail got liquidated. Banks won. The concentrated short positions held by too big to fail banks, still happening. A 2020 investigation revealed JPMorgan traders had placed thousands of deceptive futures orders to manipulate gold and silver prices between 2008 and 2016. They paid fines, but admitted no wrongdoing. The same players, the same game, the Federal Reserve intervention to save banks while crushing commodities. That's the entire playbook since 2008. Every time markets wobble, the Fed prints money to rescue institutions, while inflation destroys purchasing power for everyone else. Your grocery bill is proof. But here's where it gets darker. Silver wasn't just another commodity that got caught in market chaos. It was specifically targeted because of what it represents, a historical alternative to fiat currency. For centuries, silver was money. The U.S. Constitution defines a dollar as a specific weight of silver. Until 1965, American quarters and dimes contained 90% silver. People understood that real money had intrinsic value. The financial elite couldn't tolerate a 2008 scenario where scared investors fled paper assets and rediscovered silver as monetary protection. That would have exposed the entire fractional reserve banking system as the confidence game it is. So they used derivatives, paper contracts, backed by nothing, to manipulate the price of physical silver. They created infinite paper silver through futures contracts, then sold it in massive coordinated dumps to overwhelm buyer demand. Think about the absurdity. The COMEX trades more paper silver in a single day than the world mines in an entire year. It's pure price suppression through synthetic supply. Sound familiar? It should. Because the exact same derivative-based manipulation happens in stock markets, bond markets, and currency markets every single day. The 2008 silver crash was proof of concept. It proved that no matter how much real demand exists, derivative contracts can override physical reality as long as regulators look the other way. And they always look the other way, because the regulators are captured. The Commodity Futures Trading Commission, the CFTC, the agency supposedly policing these markets, is staffed by former Goldman Sachs executives, former JPMorgan traders, and former Federal Reserve officials. The foxes guard the henhouse and the chickens keep disappearing, but the conspiracy runs deeper than simple price manipulation. The real question is this: why does silver specifically threaten the financial system? Here's where most people get it wrong. They think silver crashed in 2008 because it's just a commodity, subject to typical market forces. But silver is different. It's the only metal that's simultaneously an industrial necessity and a monetary alternative. And in March 2008, someone high up in the financial power structure made a decision to ensure silver would never again be viewed as safe haven money. That decision involved something called the Exchange Stabilization Fund, one of the most secretive and powerful tools in the U.S. Treasury's arsenal. Created in 1934, the ESF operates with virtually no congressional oversight. It has $200 billion in assets and the legal authority to intervene in foreign exchange markets, gold markets, and by extension, anything that threatens dollar stability. Most people have never heard of it. That's intentional. In March 2008, as financial markets were disintegrating, the ESF, working in coordination with the Federal Reserve and the Bank for International Settlements, authorized dollar swap lines that provided unlimited liquidity to major banks. But here's the mechanism nobody talks about. Those same banks were drowning in bad derivative bets, including massive short positions in precious metals futures. When the Fed and ESF flooded the system with dollars, they didn't just stabilize banks, they gave those banks the ammunition to double down on their silver shorts. JPMorgan alone held a short position estimated at 25% of annual global silver production. That's not hedging, that's market control. The crash wasn't organic, it was strategic, and the architect wasn't some rogue trader or algorithmic glitch. The order came from the very top of the central banking system. Because in March 2008, the last thing they needed was millions of Americans rediscovering that silver has been money for 4,000 years, while Federal Reserve notes have been failing experiments for barely a century. But it gets better, or worse, depending on your perspective. The same month silver crashed, something else happened that got buried in the chaos. The London Bullion Market Association, the LBMA, the global hub for precious metals trading, quietly suspended the publication of daily silver lending rates. Why? Because the rates were spiking, indicating a shortage of physical silver even as paper prices collapsed. That's the signature of manipulation when paper and physical markets completely disconnect. Think about what that means. The price on your screen showed silver falling, but the actual metal? It was scarce. Dealers were sold out, mints had waiting lists, industrial users were scrambling. The paper price was a lie, weaponized to shake out retail investors and prevent a run on physical metal that would have exposed the whole fractional reserve scam. Now here's the twist that should make your blood run cold. The exact same playbook is operational right now in 2025. The derivatives market for silver has exploded to over $5 trillion in notional value. That's 250 times the actual annual global silver supply. $5 trillion in bets on a market with $20 billion of actual physical metal. It's a powder keg. And who holds the biggest short positions today? The same banks: JPMorgan, HSBC, Citibank. The ones who've paid fines for manipulation but never stopped manipulating. They've just gotten better at hiding it behind high-frequency trading algorithms and offshore derivative structures. But here's what should terrify you about the modern version of this scam. It's not just silver anymore. The derivative casino has expanded to everything: oil, copper, lithium, agricultural commodities, even carbon credits, and weather derivatives. Every essential resource humanity needs is now controlled not by supply and demand, but by paper contracts in the hands of a dozen megabanks. The 2008 silver crash was the proof of concept. It demonstrated that physical reality doesn't matter anymore. Only derivative positioning matters. And whoever controls the derivatives controls the price, controls the narrative, controls the world. So who gave the order in March 2008 to make sure silver would never threaten the dollar system again? You won't believe the name. And the receipts are wilder than you think. But before we expose that, you need to understand the actual mechanics of how they pulled it off. Because once you see how the magic trick works, you can never unsee it. Let's get into the weeds, because this is where the real crime happens, hidden in complexity that most people never bother to understand. The weapon of choice wasn't guns or laws, it was derivatives. Specifically, silver futures contracts and options on COMEX. Here's how it works in simple terms. A silver futures contract is a paper agreement to buy or sell 5,000 ounces of silver at a specific price on a specific date. You don't need to own any actual silver to sell these contracts. You just need margin, a deposit, typically 5 to 10% of the contract value. So let's do the math. In March 2008, with silver at $20 per ounce, a single 5,000 ounce contract represented $100,000 worth of silver. But to sell that contract short, betting the price will fall, you only needed about $7,000 in margin. That's 14 to 1 leverage. Now imagine you're JPMorgan, and you've inherited Bear Stearns' short position of approximately 120 million ounces. That's 24,000 contracts representing $2.4 billion in silver. But you only need $168 million in margin to hold that position. And you're a bank with access to unlimited Federal Reserve liquidity through the discount window. You have infinite ammunition. Retail investors have their life savings. Here's the exact mechanism they used. Coordinated paper dumping during illiquid trading hours. In the futures market, most volume happens during New York and London trading hours. But the exchanges operate 23 hours a day. At 2 a.m. Eastern Time, when volume is thin, a massive seller can dump thousands of contracts in minutes, overwhelming the bid side of the order book and creating a cascading price crash. This isn't theory. Documented evidence from CFTC investigations shows that between 2008 and 2016, JPMorgan traders executed over 50,000 instances of spoofing, placing large fake orders to manipulate prices, then canceling them before execution. The bank paid $920 million in fines in 2020. That's not a penalty for a bank that made tens of billions from the manipulation. It's a business expense. But here's the truly parasitic genius of the scheme. When paper silver crashes, it triggers stop-loss orders from retail traders, margin calls that force liquidation, and panic selling from inexperienced investors who watch their positions evaporate. All of that selling creates even more downward pressure, amplifying the crash far beyond the initial dump. Meanwhile, the same banks who caused the crash are waiting with buy orders at the bottom, covering their shorts at massive profits, then going long for the inevitable bounce. They profit on both sides, down and up, while retail investors get slaughtered. Let's quantify the theft. From March 17 to April 1st to date, silver fell from $20.92 to $15.23, a $5.69 drop. If JPMorgan held a 120 million ounce short position and covered at the bottom, their profit was $682 million. In 2 weeks, from manipulating paper contracts while contributing nothing to the real economy. But the mechanism gets even more insidious when you understand the role of options. A put option gives you the right to sell silver at a specific price. In early March 2008, someone, likely multiple banks acting in coordination, purchased massive quantities of put options, betting silver would crash below $16. These contracts were dirt cheap when silver was trading above $20 because the market thought a 20% crash was unlikely. When the crash happened, those put options exploded in value, some by 2,000% or more. If you knew the crash was coming because you were planning to cause it, buying puts beforehand is the ultimate insider trade. And it's almost impossible to prove in court because banks can claim they were just hedging, just managing risk. This is moral hazard in its purest form. Banks take reckless derivative positions, knowing they're too big to fail. When their bets go wrong, the Fed bails them out. When their bets go right through manipulation, they keep the profits. Heads they win, tails you lose. Now let's talk about the shadow banking element, because this is where most people's eyes glaze over, and that's exactly why the scam persists. In March 2008, the physical silver market and the paper silver market completely disconnected. Refiners couldn't keep up with demand for bars and coins. Premiums, the markup over spot price for physical metal, spiked to 50% or more in some cases. Investors were paying $23 for silver coins, while the COMEX paper price showed $15. How is that possible? Because the COMEX doesn't trade physical silver, it trades contracts that almost never result in physical delivery. Of the thousands of contracts traded daily, fewer than 1% ever deliver actual metal. It's a pure paper casino where the house sets the price, and that price has no connection to physical reality. But here's the mechanism that makes it systematic rather than coincidental. Authorized participants. These are banks and financial institutions with special access to create and redeem shares in silver ETFs like SLV, iShares, Silver Trust. When investor demand for physical silver exposure surges, these APs are supposed to buy physical metal and create new ETF shares. But in March 2008, something strange happened. Silver ETF inflows continued even as the price crashed. Money was flooding into silver funds, but the price kept falling. How? Because APs weren't buying physical silver proportional to the inflows. They were using operational shorting, temporarily going short to hedge the position, planning to acquire metal later at lower prices. This created phantom supply. Investors thought they were buying silver. They were actually buying IOUs backed by derivative hedges. When everyone tries to redeem those IOUs simultaneously, as they did in early 2008, the system breaks. Physical shortages emerge while paper prices crater. It's the same mechanism that caused the 1930s bank runs, just repackaged for commodities. Fractional reserve alchemy applied to silver. Let's get specific with numbers because this is where the conspiracy becomes undeniable. In March 2008, the total open interest in COMEX silver futures was approximately 140,000 contracts, representing 700 million ounces. Global annual silver production, 680 million ounces. The paper market exceeded annual physical production. JPMorgan's acquired short position from Bear Stearns represented approximately 25% of annual global silver supply. For context, any position above 5% typically triggers regulatory scrutiny for market manipulation. JPMorgan held 5 times that threshold. The CFTC did nothing. Between March 17 and March 24, 2008, silver fell 18% despite the U.S. Mint reporting a 92% increase in Silver Eagle coin sales compared to the previous month. Demand surged, supply was tight, and the price collapsed. That's not economics, that's engineering. During the crash, trading volumes in silver futures spiked to over 250,000 contracts on some days, representing 1.25 billion ounces, nearly twice annual global production. But physical market transactions barely changed. The price was being set by a paper tornado with no connection to actual silver. From 2008 to 2013, JPMorgan Chase accumulated 55 million ounces of physical silver, the largest private hoard in American history, while simultaneously maintaining short positions in paper markets. They suppressed the price through paper contracts, then bought physical metal at artificial discounts. That's not investing. That's looting. Now, let's talk about the broader derivatives ecosystem, because silver was just one theater in a global war on price discovery. In 2008, the total notional value of over-the-counter derivatives, the OTC derivatives, the unregulated contracts traded directly between banks, not on exchanges, exceeded $680 trillion. That's 10 times global GDP. These derivatives weren't tools for managing risk. They were weapons for concentrating power. Credit default swaps let banks bet on corporate failures, they themselves engineered through predatory lending. Interest rate swaps let them profit from central bank policies they lobbied for. Commodity derivatives let them control food and energy prices disconnected from supply and demand. Silver was practice, a beta test, a proof that paper contracts could override physical reality if you had enough leverage and regulatory capture. The genius of the scheme is its opacity. When you buy a share of Apple stock, you own a piece of a company. When you buy a gold ETF share, you theoretically own gold in a vault. But when you trade silver futures, you own a legal promise that's only as good as the counterparty's solvency. And the counterparties are the same too big to fail banks the government will never let collapse. It's a closed loop of corruption. Banks make reckless derivative bets. When bets fail, taxpayers bail them out. When bets succeed through manipulation, banks keep profits. Regulators who might intervene are promised lucrative jobs at those same banks after they leave government. The CFTC has had over a dozen commissioners go directly from regulating banks to working for them. This is why the 2008 silver crash doesn't matter in the way most people think. It doesn't matter because silver recovered. It hit $48 by 2011 before getting crushed again through the same mechanism. It doesn't matter because investors got liquidated and moved on. What matters is the precedent it set. The proof that financial derivatives can override market fundamentals indefinitely as long as central banks provide unlimited liquidity. The demonstration that price discovery is dead, replaced by algorithmic manipulation and coordinated institutional fraud. The 2008 silver crash was a heist. But more importantly, it was a message. We control the price of everything, and there's nothing you can do about it. That message has been reinforced every day since. In 2020, when retail traders tried to squeeze silver shorts through Wall Street bets coordination, what happened? COMEX raised margins, brokers restricted buying, the price got hammered. Same playbook, different decade. The system isn't broken. It's working exactly as designed to extract wealth from the many and concentrate it in the hands of a few mega institutions operating above the law. But here's what they didn't count on: the internet, decentralized information. Millions of people comparing notes, sharing data, documenting manipulation in real time. The conspiracy only works if most people don't understand it. You're understanding it right now, so where does this leave us in 2025? In a system that's faster, more algorithmic, more hidden, and more dangerous than what crashed silver in 2008, the derivative casino has metastasized. The Bank for International Settlements estimates the global derivatives market exceeds $700 trillion in notional value. That's more than 8 times global GDP. We're living inside a financial weapon of mass destruction, and the banks holding the detonator are the same ones who crashed silver, crashed housing, crashed entire countries. And they've learned nothing. Or rather, they've learned they can get away with anything. The next crash, and it's coming, will make 2008 look like a dress rehearsal, because now the manipulation isn't just in commodities. It's in sovereign bonds through central bank repo markets. It's in equities through index fund dominance and passive investing that eliminates price discovery. It's in currencies through digital central bank money that eliminates the possibility of escape into tangible assets. Silver's 2008 crash was a microcosm, a single thread in a tapestry of financial engineering designed to maintain the illusion that paper promises can substitute for real value indefinitely. But every Ponzi scheme ends, every fractional reserve system eventually faces a run, every currency backed by nothing eventually returns to its intrinsic value, which is zero. The question isn't whether the system will collapse. It's whether enough people will understand what happened before the next one hits. This is about more than silver prices or investment portfolios. This is about the fundamental architecture of modern economics, an architecture built on borrowed time, leveraged fraud, and the assumption that you're too distracted or too exhausted to notice you're being robbed in slow motion. Every dollar you earn loses purchasing power because the same banks that manipulated silver lobby the Federal Reserve to print infinite currency. Every investment you make is subject to derivative manipulation by institutions with asymmetric information and regulatory capture. Every market you trade operates in a shadow banking system designed to privatize profits and socialize losses. The 2008 silver crash proved the game is rigged. What you do with that information determines whether you're a victim or a witness when the next rigging happens. So here's my final question to you. Are we wiser now, or are we just walking the same path in better suits with faster algorithms? The evidence says we've learned nothing. Derivative markets are larger. Concentration is worse. Too big to fail banks are bigger. Central bank balance sheets have exploded from $5 trillion in 2008 to over $30 trillion today. We didn't fix the problem. We made it unfixable. But individually, you can choose differently. You can understand that price is not the same as value, that paper promises are not the same as tangible assets, that a system built on infinite leverage and zero accountability is not a system worth trusting with your future. The elites who engineered the silver crash are counting on your denial, your complacency, your exhaustion. They're betting you won't connect the dots between what happened to silver and what's happening to your purchasing power, your retirement account, your economic freedom. prove them wrong. If this video opened your eyes to how deep the manipulation goes, share it. Not because I need views, but because the only defense against coordinated institutional fraud is coordinated public awareness. Leave a comment with your biggest takeaway. Hit subscribe if you want more unfiltered truth about how money really works in a system designed to obscure its own corruption. The clock is ticking. The derivatives are piling up. The next crash is baking. The only question is this: will you see it coming this time?